Hello and welcome to an introduction to the Guaranteed Sales Price Programme from HCR Group. I'm Adrian Leach, Managing Director at HCR Group, and I'm going to explain how Guaranteed Sales Price Programme works. What is a GSP programme and why did it start in the first place? I think the first thing to mention is that a Guaranteed Sales Price Programme means exactly the same thing as a home sale programme when they're talked about. GSP is HM Revenue and Customs approved process. It allows an organisation to value an employee's property and then release funds to allow that employee to relocate as a chain-free buyer in a new location for a valid business reason. In the early 1980s, the financial organisations in the UK needed to relocate their top management quickly into London and other financial centres. With a booming housing market, a chain-free buyer gave employees the ability to move quickly and have an advantage during purchase negotiations. The GSP programme was designed by a small group of relocation professionals, and HCR led the way in negotiating a clear process with HMRC, and this ensured that there was no betterment for the relocating employee or that opportunity for fraud in the process was taken away. In the late 1980s, many organisations were using the process to free up senior employees from waiting to sell their property before they moved, and that included a lot of the UK government departments. A few of the larger relocation companies started their own GSP divisions, although some changed the name of the programme to Home Sale in order to differentiate themselves. Often the real differentiation was how the funding was provided, because many relocation companies that offered GSP had to rely on their clients to fund the moves because they couldn't secure an appropriate credit line. However, in the 1990s there was yet another housing crash, and the GSP programme case volumes dropped as some organisations found they were paying significant sums to cover the difference between the valuation and the actual sales price. A loss on sales, this is called. Counterintuitively, it should have been a time for increased use of the programme as relocating employees got stuck in a cold housing market. But the reality was that many had negative equity, and that wasn't a situation that was easily overcome. As the housing crash ended and prices started to stabilise once again, so GSP volumes picked up, although never to the levels of the boom years of the 1980s. However, in the subprime economic recession of 2007 and 8, yet again house prices dipped, although not nearly as dramatically as 1990, with further losses being sustained by companies. One of the biggest challenges was that good relocation companies were carefully watching the housing market and urging their clients to lower the asking price. But HR personnel were reluctant to move until it was too late. This slow response to a rapidly moving market resulted in larger loss on sale than should have been expected, putting off users who then thought that GSP was too risky and too expensive. You might take from this potted history that GSP programme has no future, but as a mobility tool it was invaluable, and I still believe it has a place in employee relocation. What is the process? To better understand how the process works, I'm going to run through in a simplified way an example property placed into the programme. Before we commence a GSP programme, we have previously determined who is going to fund it, our client or whether or not HCR is advancing the funds. We do have a credit line to allow this to happen. We also have ensured that the relocation service agreement has been signed, which clarifies the roles and responsibility within the HMRC guidelines. Upon the receipt of initiation from our client, we instruct two independent valuers from the Royal Institute of Chartered Surveyors, RICS, to attend the property to provide us with a market value. The valuers send in the report with the condition of the property and using their institute guidelines called the Red Book. The Red Book definition of market value ensures that the valuer examines the previous sales for that property type in that area over the last 3 months and what is currently on the market, and they have to provide evidence of comparable valuations to support their conclusions, and finally they recommend a market value. If the valuations are within 5% of each other, HMRC would normally recommend a guaranteed price is offered to the homeowner, which is the average of the two amounts. However, sometimes the valuers do not agree. At this stage, we ask for a third valuation, and then we suggest a guaranteed price, which is the average of the two lower prices. Once the file has been audited here and the guaranteed price approved by the client, then this is offered to the homeowning employee. They then usually have about 14 days to decide whether or not to take the offer. Assuming that they accept the offer, HCR buys in the property to the programme, but we don't actually buy it in. It is secured under a power of attorney, and the asset is placed in our special purpose vehicle, HCR Funding Corporation Limited, in order to protect it. Because the property isn't actually sold, there is no stamp duty payable. Meanwhile, the homeowner knows exactly how much they have after taking into account the mortgage settlements to allow them to purchase a property in the new location. As a chain-free buyer, they can negotiate robustly and help break the inevitable property sale chains that occur, making them an invaluable buyer. Concurrently, we are marketing the old property and attempting to get a sale which is in excess of the guaranteed price. Often we're asked to sell at 105% of the guaranteed price, but sometimes circumstances do not make this a sensible approach. If we sell over the guaranteed price, it is called a gain on sale. This is usually given to the employee, but some clients keep a percentage back if the property hasn't sold quickly to offset some of the maintenance costs. Some clients do not give anything back to offset all the costs. Any gain is not subject to capital gains tax, but you would need to check this with your tax advisor, as I cannot give any advice in this area. Clearly, there are times when it doesn't go to plan and the property is eventually sold below the guaranteed price. This is called a loss on sale. The difference between the guaranteed price and the final sale price must be paid by the employer. It is a cost of providing that relocation support. It is deemed a legitimate business expense and can be offset against corporation tax. If the old property becomes empty as the homeowner relocates to their new home, then we take over management of the property whilst it's being sold. Sometimes the new home is purchased and the relocating employee moves, but temporarily leaves the family behind. This is usually so a school year can be finished or while the spouse or partner works out their notice before moving themselves. This is the bare bones of the programme. There are plenty of nuances, and with the right advice, timely intervention and a proactive approach, there doesn't need to be a loss on sale, but you need to know that it happens. What costs are involved? Well, compared to some relocation policies, GSP is seen as expensive, and understandably so. Let's consider some of the costs. Funding. Banks charge for a credit line, which although it can be used multiple times, can be quite expensive if only used once. Obviously, wealthier corporations can fund the programme themselves, but there is still the opportunity cost to consider and the inevitable administration. I even heard an FD once complaining that his balance sheet was being impacted by GSP property. There is an interest on the funding that needs to be paid. At the moment it's really quite low, as in November 2017, but the rate is approximately 2.75% above LIBOR, the London Interbank Operating Rate, and the 3-month one as well. There are 4 lots of legal fees to pay. One set for HCR to buy the property into the programme, one set of legal fees for HCR to sell the old property to the new buyer out of the programme, and then 2 sets of legals, one for the homeowner to sell their property into the programme in the first place, and one to buy their new property. Each have their disbursements like land registry fees and searches. There is obviously stamp duty for the homeowner to buy their new property. Although there's no stamp duty to sell the old property into the programme, because the old property isn't actually sold, but secured under a power of attorney. There are at least 2 valuation fees which are being charged by the RICS valuers, and of course if they haven't agreed and they're not within 5%, possibly a third one. The old property will need maintenance, and there are management fees associated with that, and specific empty property or vacant property insurance that is payable. There are estate agent fees that need to be paid as well, although the good news is most of those tend to be capped at a rate well below those advertised by the estate agents to the public. There are other costs to consider as well, items like mortgage redemption fees to allow the employees to settle a mortgage or transfer it. There are specialist property reports on both the old and the new property, and certainly a home buyer's report for the new property is highly recommended. Well, if you listen to me so far, you're probably thinking, what are the benefits to the client and the transferee for doing all this? And it's a good question. Well, predominantly it's about getting your employee to move quickly to their new location and manage to take their family with them. Employees who have to take up a new post and then make a long daily or weekly commute soon get tired of living out of a suitcase whilst missing their family. It can also get very expensive putting up an employee and possibly their family in serviced or rented accommodation while they sell the house, which may be many miles away. Selling a house is stressful enough without having to struggle to cope with estate agents, lawyers, potential buyers and maintenance people, and you're at a considerable distance away from them. Leaving the property empty often isn't an option either, as most household insurance companies only allow between 28 and 60 days to be empty, after which they withdraw insurance cover. That isn't helpful when pipes freeze in winter because the heating is off or the employees having to heat an empty house. Running a GSP program may seem daunting in its complexity, but with the right provider it can be quickly and easily accomplished. As a tool to support a senior employee selling up their old home and moving to a new location where they are needed, it's invaluable. It takes away all the stresses and strains associated with selling and buying a house, speeding up the employee's ability to settle into their new role to tackle the reasons that they were relocating in the first place. It keeps families together, creates the right work-life balance, and demonstrates the organisation's support to their key talent. In fact, as a senior talent management tool in the UK, it is absolutely invaluable. If you wish to learn more about how a GSP program can help your company and your employees, our email address is shown below and you can visit our website at www.hcr.co.uk. We're always happy to hold a no obligation exploratory meeting to understand what it is you're trying to achieve and then give you an honest appraisal on whether or not GSP or perhaps a similar service can be of any help to you. Well, thanks for watching, thanks for listening. I hope this relocation briefing has helped explain a little bit more about GSP.